So this time we're going to be reversing the adjusting entry we did for unearned revenue. So let's go back up to the unearned revenue just to recap the adjusting entry we did. Didn't I color code it? There it is, unearned revenue. Now, quick recap on unearned revenue, usually and often being the most confusing adjusting entry, in part because a lot of businesses, possibly most businesses, do not have unearned revenue because most businesses are going to do the work either before they invoice the client or before they get paid or at the same time they get paid, such as in a cash register type of situation. And therefore, you're not going to have any unearned revenue, which is a result of getting paid before you do the work. And remember our classic examples, the ones that are probably still in textbooks even to this day, even though it's somewhat antiquated, are like a newspaper, right? So nobody buys the newspaper anymore except if out of tradition because it's basically worthless at most of them, basically worthless at this point. But if by tradition you like to have someone throw that thing at your house and no longer a kid on a bike, some creep in a van driving around, hired by the news organizations, of course, they probably hired directly. You have to live out of a van in order to work for the newspaper delivery. Anyway, if that's the case, then obviously you sign up for the newspaper beforehand, and then you pay the newspaper company so they get paid before they actually do the work. And then once the creepy dude in the van throws the newspaper through your window, that's when they earn their revenue, right? And so you have to basically then take it out of unearned revenue, recording the revenue when the work was done. Now, more modern examples of that would typically be like any kind of subscription model for, say, software. So if you're in a software company and people are paying you for the use of the software, they're usually going to be paying you before they use the software for a year's subscription or something like that. You collect the money, which means, again, you didn't do the work. So therefore, it shouldn't be going into revenue when you collect the money, even though that would be the easiest cash-based thing to do, but rather going into a liability of something like unearned revenue. And then, which I believe is this one, unearned revenue. And then once you earn the revenue by providing the software, then you're going to take it out of unearned revenue, decreasing the liability, recording then the revenue. Now, remember the book problem, classically, that makes sense from just an accrual standpoint, because the idea would be, hey, look, what I'm going to do is I'm just going to keep on recording every time I get paid, I'm going to put that into, instead of revenue, unearned revenue. And then periodically at the end of the month or the end of the year, I'm going to look at all the subscriptions that I had possibly, determining how much of those subscriptions I have earned the revenue for, how many newspapers were thrown through the window, earning us the revenue. And then I will determine how much to reduce unearned revenue by and how much we should increase and move into the revenue account. That makes sense from an accrual basis, but from a practical software basis, we have the added problem of the subledgers. The subledger for customers is not usually tied to a liability account of unearned revenue. Now, some software, like a Xero, for example, tries to integrate, in essence, the unearned or prepayment from a customer so that we can properly record it as a liability while still pulling that information into the subledger related to the customers, which is usually tied to the general ledger account of accounts receivable. So, but even that is still a little bit more complex, because you can see what's happening. The subledger is now representing two general ledger accounts instead of one, which again is a little bit wonky, because you're going to have to take it out of the unearned revenue and move it to the accounts receivable, at some time, for example. Some software like QuickBooks still, although QuickBooks is thinking or has been toying with some other options that will be similar to the Xero solution, but it's almost easier to say, all right, from a software perspective, what I want to do is keep all of the customers in accounts receivable. Therefore, when I receive a payment, if it's a subscription model, for example, before I actually do the work, I'm going to record it as a payment form, which is a form in QuickBooks usually designed to decrease accounts receivable. That's what it does, right? It's going to decrease accounts receivable. The other side goes into unearned revenue or the checking account, for example. But normally it's tied to an invoice. That form automatically, you would think, is always tied to an invoice, the invoice usually being entered before the payment form. But in our case, we're going to enter the payment form before the invoice, resulting in a credit balance in the customer account. It's going to look wrong on the financial statements because it's going to end up with a negative receivable. Note, not the total receivable isn't negative in the general ledger, but if I look at individual accounts over here in the subledger, I'll note that some of those individual accounts may have a negative balance. And that's going to be because that would indicate that we owe them money, not they owe us money, which is the case because they prepaid us. We're not going to give them money. We're going to give them, in the newspaper example, a newspaper through their window for their efforts. Thank you very much. Here's a newspaper through your window. And then this creepy guy in the van just keeps circling the block too, which is kind of disturbing. I kind of wish that wasn't going on. But in any case, so where was I? If we have these negative balances for a particular customer, we can just shore that up at the end of the period by generating the customer report, looking for the negative receivables, and then basically increasing the accounts receivable by that amount, and then putting the other side to not revenue, but to the proper liability account. So in other words, the software oftentimes these days can handle the tracking of how much of the revenue has basically been earned or not, because I can receive the payment and I can basically record the payment, and then I could record scheduled invoices that will automatically invoice the client monthly, for example, in accordance with the subscription. So that's not usually the problem, although that's still kind of the issue on a book problem side. The software usually handles that. The problem from the software side is the subledgers, because you get this messy business with the subledgers. So again, it oftentimes is more simple to use one subledger that has a negative account and then just shore it up at the end of the year by doing adjusting entry if needed, noting that small businesses might not need to ever do an adjusting entry, because if you're just reporting the income statement on, say, a tax return like a Schedule C, there's no balance sheet. So you don't really need to do the adjusting entry unless you need to do external reporting. You need to report the income statement, and the income statement should be reported properly using this method. So we're going to imagine in our case, we had to report the balance sheet either for external reporting purposes like to the bank to get a loan, or for investors, for example, or possibly for our internal decision-making use. And therefore, we did an adjusting entry at period end to basically record the liability. So that's where we stand at this point in time. So now we're going to have this liability of unearned revenue on the books. And we don't really want that to be the case. That's going to confuse possibly the accounting or bookkeeping department. Now we could just say, hey, look, just leave it there. It's okay because we dumped it into an account over here. Oh, by the way, one other thing on the subledgers. When we enter this into QuickBooks, for example, I'm not going to be able to enter it as a journal entry without affecting the subledger, because QuickBooks and many software like Xero force us to have a customer involved every time we post something to the accounts receivable account, because it wants to force us to have a subledger that ties out to the general ledger, which is usually a good internal control. However, it backfires for us here because we would rather not do that, because what I want to do is do an adjusting entry, which will throw the subledger off, but I'm okay with that because I'm going to reverse it right after, putting us back to where we need to be. So I'd rather just hit the general ledger and not touch the subledgers at all, because that's going to mess up the accountant. So in other words, if, for example, there was a deposit for Mr. Anderson over here and they had a credit balance and I had to adjust for it, when I do the adjusting entry, I would do a journal entry because I want all my adjustments to be journal entries and not invoice forms. But then I'm going to see, and the bookkeeper is going to see this journal entry, which is funny to see in the subledger. We don't usually see that type of form in the subledger. usually they only see invoices and payments. So that's going to mess them up, right? And so when they communicate with the customer, it's going to mess them up. So what we did instead, we could make another account called accounts receivable 2 or accounts receivable adjusting entry, for example, and then and make it not an accounts receivable type account so that the software doesn't force us to have a subledger. However, that's a little bit messy in software like QuickBooks because I can't put those two accounts together and I can't make them a sub account because they're two different account types. Account software like Xero actually does allow us more flexibility, even though they're different account types, to group them together because they have a kind of a more sophisticated customization of their reports. Although with more sophistication of the reports comes more complexity in order to use them. So there's pros and cons in that. So the other option is to say, look, I'm not going to report it in Mr. Anderson's account because I don't want to mess him up. So I'm going to make another account for the customer called ZZ customer. So it's at the bottom of their customer list if they have alphabetical order that they're using. And then I'll just post all of my adjusting and reversing entries into there, hoping that although I'm going to enter them in as a journal entry form and not an invoice and payment form, which typically link together nicely, that I'll still be able to link together the journal entries in the software so that when I run reports for open items per customer, it doesn't show this one customer with a ton of journal entries that haven't been closed out or couldn't be linked to each other because we have these open journal entry forms. All right, so that's the idea.